What's going on, everybody? Welcome to another ticker feed video. And so today what we're going to be talking about is how to invest in stocks for beginners. The how to. I have been getting a lot of direct emails on how to invest, and so I wanted to break it down. And so once a week I'll be putting out some videos that's going to break down stocks and all the terminology that you need to know. So let's go ahead and get started. So look at the front page of a newspaper business section or the home page of a financial website, and you'll usually find listings for the Dow Jones Industrial, right? You always hear that. The S&P 500 and the NASDAQ, right? Now, these indexes are often treated as indicators of the overall health of the stock market and of the economy as a whole, but in truth, they tell you something only about certain segments of the market, okay? Now, probably the most famous stock market indicator of them all is the Dow Jones. Okay, it is the most exclusive. Now, the Dow includes 30 stocks, all of which are among the largest, richest, and most heavily traded companies in the United States. Now, the Dow includes companies from all major sectors except utilities and transportation, which have their own separate Dow Jones indexes. Now, although many people view the Dow Jones as an indicator of the broader market, in reality, the movements of the Dow tell you something only about how large blue chip stocks are faring. Now, when it comes to the NASDAQ index, the NASDAQ Composite Index includes all companies listed on the NASDAQ stock market, more than 3,300 stocks in all. As such, it is considerably more, I would say, broad-based than the Dow. Now, however, the NASDAQ has a high concentration of technology stocks, so the composite index is more sensitive to that industry than other sectors. Keep that in mind. Now, the composite index shouldn't be confused with the NASDAQ 100, which is an index of the 100 largest companies listed on the NASDAQ stock market. Now, for the overview of the S&P 500, the Standard & Poor's, the companies behind the S&P 500, builds it as the best single gauge of the current condition of the U.S. equity markets. Now, the index includes 500 companies from all sectors of the economy with stocks listed on either the New York Stock Exchange or the NASDAQ. Combined, the companies in the S&P 500 account for about 75% of all U.S. stocks. Although the S&P 500, like the Dow, is made up of large companies, it is still considered a more reliable gauge of the broader market because of the sheer number of companies it tracks. So I thought that was pretty beneficial, but with that being said, let's continue, right? So we're looking at the small cap, mid cap, large cap. Now, with the large cap stocks and small cap stocks are two of the three primary categories of stocks as measured by size. The third category is the mid cap size, right? So cap is short for market capitalization, for those that didn't know that. Now, which is a way of measuring a company's size by multiplying its outstanding shares by its share price, okay? So tip, large cap stocks are issued by corporations with a market capitalization of 10 billion or more, and small cap stocks are issued by corporations with a market capitalization between 250 million and 2 billion, which again, I feel like that's added value. Now, the sizes of the stock. The majority of stocks available to the public are large cap stocks. In fact, the best known companies in the United States are large cap stocks, and that's going to include what most people know. So GE, right? So General Electric, Coca-Cola, Google. Now, according to the Dow Jones, which rates the stock of the 30 largest in the U.S., approximately 70% of the stocks are large cap stocks, right? So, but with approximately 5,000 different U.S. index companies, expected to see the percentage rated differently among them. So again, I want to keep that in mind for everybody to understand that. Now, with that being said, let's continue. Now, the differences in growth. Now, small cap stocks and large cap stocks typically operate are differently in different stages, right? So small cap stocks are typically younger and seek to achieve, I would say, more of an aggressive growth. Now, ultimately, behind the mid cap and then the large cap status, because they have a lot of room to grow, they often offer greater potential gains in share price and a higher return for investors, which makes sense, right? That's going to be common sense. Now, many large cap stocks, meanwhile, are so big that it is more difficult to achieve massive growth. Now, small cap stocks represent much higher risk investments than large cap stocks, right, which are known as penny stocks. Now, future success is not certain for these companies. Management is often short on the experience, and many of the companies still lack typically resources, I would say. Now, in contrast, large cap stocks typically have a proven track record of over many years. They frequently have a broad mix of products, while small caps have fewer products and a smaller margin for error, which makes sense, especially when it comes to regulations with the SEC. Now, the use of dividends. Large cap stocks frequently offer dividends as an incentive for investors, providing a steady source of income and a financial motive to purchase those shares. Now, dividends are payments to shareholders from a company's profit and are distributed at regular intervals, right? So most of the time that's going to be 3 times to 4 times a year. It just depends on what's going on, especially what happened recently last year. Now, small cap stocks do not offer dividends to their investors nearly as often as large cap stocks. Instead of issuing dividends with their profits, small cap stocks are likely to reinvest these profits into the company, which fuels the growth. So, which makes perfect sense, and that's what you want to know, because I mean, if you're trying to buy a stock and get dividends because you're trying to live off of them, you might want to look into it a little more, right? Now, when it comes to mutual funds themselves, right? What are mutual funds? Now, mutual funds are investment strategies that allow you to pool your money together with other investors to purchase a collection of stocks, bonds, or other securities that might be difficult to recreate on your own. Now, this is often referred to as a portfolio. So I'm sure you've heard that asset allocation model, something along those lines. Now, the price of the mutual fund, also known as the net asset value or NAV, is determined by the total value of the securities in the portfolio, dividend by the number of funds outstanding shares. Now, this price fluctuates based on the value of the securities held by the portfolio at the end of each business day. So please keep that in mind. Now, the case of mutual funds. For the average small investor, mutual funds can be a smart and cost-effective way to invest, while individual purchase minimum may vary by fund and can be as low as $100. Most funds will let you buy shares with at least $2,500. Now, in addition, minimums are often waived or reduced if investors buy a fund within a retirement account or use certain brokerage features like automatic investments to regularly invest over a set time period. Now, buying shares in a mutual fund is also an easy way to help diversify your investments, which is really another way of saying that you won't have all your eggs in one basket, which you don't want to do. Now, for instance, most mutual funds hold well over 100 securities. For someone with a small sum to invest, building and managing a portfolio containing that many securities could potentially be highly impractical, if not impossible. So always keep that in mind and check out the professional managements. I'm not a financial advisor, but knowing this information should be able to help you weigh, and then you can have those key takeaways, right? Now, with that being said, let's finish this video off with the buying, right? Now, what I use is going to be Fidelity. Now, when you actually go on Fidelity and you create your account and you're ready to buy, first thing you're going to notice is going to be the symbol. So what the symbol is going to be, so for example with Coca-Cola, KO, right? The ticker symbol. So I'm sure you've heard that before. That's what you plug in there, right? Then you go ahead and look at the action. So are you buying? Are you selling? What's the quantity? Now here's the two things that I wanted to point out. You've got market order, limit order, or good till canceled. So place the order at the market. Market orders are transactions meant to execute as quickly as possible at the current market price. Place the order at limit orders. Set the maximum or minimum price at which you are willing to buy or sell. So buying stock is a bit like buying a car. With the car, you can pay the dealer's sticker price and get the car, or you can negotiate a price and refuse to finalize the deal unless the dealer meets your valuation. So keep that in mind. The stock market works in a similar way. So a market order deals with the execution of the order. So in other words, the price of the security is secondary to the speed of completing the trade. Now, limit orders, on the other hand, deal primarily with the price. So if the security value is currently resting outside of the parameters set in the limit order, the transaction does not occur. So please keep that in mind. So the key takeaways: market orders are transactions meant to execute as quickly as possible at the current market price. Limit orders set the maximum or minimum price at which you are willing to complete the transaction, whether it's to buy or sell. Market orders offer a greater likelihood that an order will go through, but there are no guarantees as orders are subject to availability. Now, with that being said, good till canceled, right? So you can put these orders in and then you can have it good till canceled, which means, all right, a year from now, I want to be able to buy it at this price. So you can actually put that order out all the way in a year from now and wait until that happens, because again, the market goes up and it goes down. Now, guys, I really do appreciate you listening to the Ticker Feed channel and just listening to this video. I hope this was added value. I really enjoy and I have a huge passion of just trying to educate people as much as possible. That way they can make the best decisions and the best choices, because for me personally, I never had anyone that would do that for me or ever did, and so I've had to learn on my own. And so again, if I can save you time, I feel like I'm doing my job. And with that being said, guys, welcome to the Ticker Feed family.